Elon is not a friend to Tesla shareholders. In fact, he doesn't care about them at all. Look at him laughing at this dead deer. That's how he laughs at us too. Memes and screwing over Tesla shareholders, those are the two things that really gets Elon going. And in this video, I'm going to tell you why. And obviously this is important because a lot of us, including myself, have bought and are holding Tesla shares. And realistically, with Tesla joining the S&P 500, most people are gonna have some exposure to that stock now, regardless of whether they wanted to buy Tesla or not. Why? Well, that's because that's how retirement funds work. Most of your mutual funds, 401ks, all that stuff, they're usually very closely tied to the S&P 500, that index, which Tesla is going to be a part of. So that means Tesla's stock price is going to have a major impact on all of our finances going forward, whether we like it or not. So it may be a little bit worrisome that Elon doesn't care about shareholders. And you may be asking, hey, why is it even a problem that he doesn't care about shareholders? Well, it's kind of the job of the CEO of a corporation to care about that. And that's because a corporation's job is to maximize shareholder value. That means do the best thing you can for stockholders to make them money. And the stockholders, that's us. Now that's not legally binding or anything. Well, it sort of is with their fiduciary duty. But the idea behind the corporate's job to maximize that shareholder value, that started in the 70s. And a big reason why it became popular is because of this guy right here, Milton Friedman. And you've probably heard of him because he's one of the most famous economists ever. Won the Nobel Prize. All about free markets. People stan him a lot. So the idea is, as shareholders, we're the boss. And Elon is supposed to work for us. So he's supposed to make us money by making the stock price go higher or paying dividends. Elon, though, it seems that he actively works against that goal. And he does that in a few ways. The first way being, I mentioned dividends before. Do you think he'll ever pay a dividend on Tesla stock? No. Never. What about our shareholder value? But more than that, the guy jumps on Twitter to actively manipulate the stock price. Remember earlier this year when he tweeted that Tesla's stock price is too high in his opinion? Are you kidding me? How is that supposed to help the price go any higher? And he said a bunch of stupid stuff on his Twitter. It's got him in trouble with the SEC for manipulation. He said other things in interviews too, and basically all together it puts a lot of risk into the stock. And you start to think, yeah, he doesn't want this thing to go up or what? But you could take it a step beyond that with how he manages the stock price himself. And the way he affects that is by issuing new shares into the market, which he has done twice this year. He issued 2 billion shares in February back here, and you can see the stock price drop pretty hard as a result. And now he's doing it again before the end of 2020. But this time he's issuing 5 billion worth. So what does it mean to issue new shares onto the market? Well, basically you're selling more shares to collect more money. So think about if Tesla had, say, 100 shares on the market. Elon is going to issue, say, 20 more. And by selling those shares, he's collecting more money for the company. Now, the problem is that actively hurts shareholder value because we're all holding the old shares. So what happens is by issuing new shares, it dilutes the previous shares. And that's because of the concept of a market cap in a company. And the market cap of a company is basically when you take the number of shares and multiply it by the share price. So you get the total value of what that company is worth, the market cap. In Tesla's case, the current market cap is $594.4 billion. It's insane. But let's do a quick example that's a little more simple. Say you have a market cap of $100 and say there's 100 shares. So how much is each share worth? You would do 100 divided by 100 equals $1 a share, right? Now say this company issues another 100 shares. So the market cap stays the same, right? It's 100 because issuing shares shouldn't change the market cap. But now you have 200 shares. So you do 100 divided by 200, and what is each share worth? 50 cents. And there you go. That's the dilution right there. So every person who held the original 100 shares, now they're worth 50 cents a piece instead of $1. So really, instead of maximizing shareholder value, he's minimizing it. And another problem is that when there's more shares out there, so say 200 shares instead of 100, then it's tougher to actually move the stock price higher, or it becomes tougher because there's more shares. And how many shares of a company there are, that's called the float of the company. And the reason it becomes harder is again because of supply and demand. So if there's a certain amount of investors that want Tesla stock, they're the demand, right? And if the supply was originally 100, but now it's 200, then that demand didn't necessarily change. So if there's more supply now than there is demand, then prices are going to go down, which is why a good strategy in the stock market when you're dealing with smaller companies is to look for companies with a small float, a small number of shares. And those are the companies where you could see the stock price really rocket, because when investors start flooding in, there's only so many shares available available. There's a small amount. So there's all this demand coming in, a small supply. So the price of each one of those shares just shoots up way faster. Versus if there's a bunch of shares and still a bunch of demand, each individual share, the price won't shoot up as fast. Now, what a lot of companies do is actually the opposite. To increase shareholder value, instead of issuing more shares onto the market, they buy their shares back. And I talk about this a lot, but this has actually been a huge driver for the stock market since 2009. All these companies had a bunch of cash and they just keep buying back their own shares. So what happens is that they have to buy it back, right? So that buying pressure pushes stock prices higher because, again, supply and demand, right? More demand, same supply, it's going higher. But when the company buys back its own shares, it takes it off the market. So it's increasing demand and actually decreasing supply at the same time. So the price goes even higher. And again, what I was saying before is that a small float is better for a stock. So most companies are buying back their stock, and Elon here is issuing more shares. Who's maximizing shareholder value there? So knowing all this, should we actually be staying away from Elon and Tesla because he doesn't care about shareholders? No. I don't think so. I actually fully support Elon in what he's doing because I could care less about shareholders too, including myself. Like I said, I'm invested in this company. And here's why I think this. This whole corporate concept that's been popular from the 70s of maximizing shareholder value, I think it's idiotic. The goal of a company isn't to make their shareholders rich, or at least it shouldn't be. Of course, that's how a lot of companies and executives treat it, which is why their companies go down the drain. And I'll give you an example in a second here. But the point of a company is to maximize value for your customers first with the product that you're selling. That's your main goal. And then I think secondary after that is your own employees. Take care of them, pay them more based off the profits that you're making by making your customers happy. If you do those two things, you'll end up having a reflexive loop because you'll grow your customers because they're so happy, and you'll make your employees happier and happier because you're giving them more money. And that's the beautiful part about capitalism. Someone pays you a small amount of money and you provide them even more value than what they paid for, and together you grow the total economic pie. That's the beauty of capitalism. So once you focus on that customer and employee, then you could worry about shareholders. But honestly, who cares about shareholders? Focusing on them, worst way to run a company. And that's why I say when Elon doesn't care about shareholders, he really doesn't. And I think it's the absolute right move because he's got way bigger things on his plate, like saving humanity, getting to Mars, getting us with renewable energy, Neuralink, trying to save us from our AI overlords in the future. Why would he care about shareholders? And honestly, I think he should issue even more shares, raise even more money while you can. That's the prudent thing to do for your company, and save that money for a rainy day or just reinvest it, which you eventually will either way. But look at this. The first time he issued shares, yeah, the stock price took a beating, but that was also during the CCPV shutdown. This time when he issues shares, we'll see what happens. But he's taking full advantage of all the hype that surrounds Tesla, and he's collecting the money because he's purely focused on his company and the future, not the shareholder. Now here's an example of a company that was fully focused on maximizing that shareholder value. One of our classic corporations, IBM, and look at this stock price right here. Since 2013, it's been falling straight down, as low as almost 60% down. It's been an absolute mess. The company is a mess. And this isn't just any company, right? This is IBM. They were a powerhouse for decades. But eventually they got a bunch of executives who try to maximize shareholder value, and this is what happened because they didn't use that money to innovate. All they did was try to buy back their shares. And that's also the problem with this shareholder value, because you know who else holds shares in the company? The executives. Now, sometimes this is a good thing because it aligns the incentives of the executives to make the company perform better so that long term the stock price goes up. But the key there is long term. And no one, politicians, executives, nobody, you and me, we barely ever think long term. Executives, in their mind, they're like, well, why am I thinking 10 years ahead? What I should be doing is just pumping the stock price as much as I can now with buybacks and collecting my bonus. That's what all the IBM executives did, and this is what happened to their stock price over time. And now the company sucks. But the best CEOs don't do that. Elon doesn't do that, and that's why his stock price is up, 700% this year? It's insane. So yes, I fully agree with what Elon is doing, but as shareholders, all of us together, we need to watch out for ourselves because the things that I said before, they're still true. He still does try to actively pretty much dilute shareholder value. Now, so far it's worked out. I mean, look at this chart. Even when he issues shares, it still keeps going up. And yeah, Tesla is up 600% now just this year. But I'll be honest with you, at this point, Tesla is super overvalued. When you see something like this, the stock price becomes very fragile. And that's regardless of how great of a company Tesla is. This type of movement normally does not stay. It does not stay up here. It would be very easy to see a 50-60% correction, meaning the stock could crash. And that could happen with no change in Tesla whatsoever. Still a great company. Elon's still making the great moves. That's just how markets work, because the stock price is not always coupled with what the company is doing. So I know a lot of people who want to buy and hold Tesla long term, but in my opinion, that is not good risk management and it's not safe when you're looking out for your own finances. And if you're a long-term bull in Tesla and you're thinking, hey, no problem, the thing can crash 90% and I'll still hold on and I'll just invest more. Well, it's easy to think that, but when it actually happens, it's way harder to do. And if you want an example of that, look at the S&P 500 in 2008, the great financial crisis when the whole world was ending. The thing dropped as much as almost 60%. And are you asking yourself, hey, why did people lose so much money in this? Obviously, it came back. Why didn't they just hold on? Well, yeah, a lot easier to say in hindsight when you can see what the market did for the rest of the time. But during this period, people bought here, sold down here. And these are people who said, you know what, I'm going to hold through everything, because it's not easy. I'm not saying it doesn't work. I'm just saying you're not going to be able to do it. And that's why actually having risk control, regardless of whatever company you're invested in, no matter how great you think it is, that's the key. That's how you stay alive in the market, and that's how you build your wealth over time. And in our Fallible strategy, we've obviously made a ton of money on Tesla this year, but we did it in a safe way. We did it while always protecting our downside in case something happened. That's the way to function in the market. Always look at the worst case scenario and plan for it and make sure you're protected. And actually in this training session right here, we explain the entire strategy that we use, not just for Tesla, but for every other stock too. And there's a big case study on exactly how we traded Tesla in this training. And it's a free training that explains what we do in detail, myself and all our Fallible members, so that you can do the same thing. So we can continue to ride this Tesla trend. So you should definitely go take that training right now. I'm going to put a link right here. Like I said, the strategy that we teach in this training, it works for Tesla, and it's even going to catch the next Tesla. I'm going to be using this thing for the rest of my life because it's so good. So definitely click this link and check it out right now. I will see you there.